Hello, my name is Thomas. I'm from investmentexcel.com, a platform for downloading advanced or slightly advanced material in finance and economics. Today I will show you how to calculate the so-called ex-post Sharpe ratio of stocks. The ex-post ratio is different from the ex-ante and more famous Sharpe ratio, which is based on expectations one period ahead of the risky asset return and the standard deviation of returns. The ex-post Sharpe ratio, on the other hand, measures the historical performance or risk-adjusted return of a risky asset or a mutual fund. I will show you the derivation of the ex-post Sharpe ratio based on William Sharpe's own contribution in 1994, where he showed how to do this and why it's not so trivial as many think. He used a concept of differential returns, which we will use here as well. This video and the Excel workbook can be found on investmentexcel.com and spotify.com. Let's look at a US company, a famous one, Microsoft. And let's assume that we have observed 25 years of prices, and this price includes dividends, so it's a gross price, so every dividend is reinvested in this price level. This implies that the return I calculate here, just by taking period price today divided by previous minus 1, it implies that this return is a gross return, so the total return of Microsoft in each period is measured here. Over here we have the return calculated in the same way, just on a risk-free asset, which we normally in practice, in performance measurement, approximate with a short-dated government bond. So in the case of the US, it could be a 3-month T-bill. Now we have the time series. We need to calculate the differential return, a factor D, as Sharpe he denoted it in 1994 in his article, and it's here. So the time series D. So for instance, year 5, the Microsoft stock outperformed by 4 percentage points the return on the risk-free asset. Let's take the average of the differential return, and we see we get 0.85. So on average, Microsoft has delivered excess return by 85 basis points. On the other hand, this is delivered on the back of risk measured by standard deviation, and it's 8.64 per period, which in this case is years, so it's also the annualized standard deviation. If we take the relative value between the average and the standard deviation, we have the ex-post Sharpe ratio. So in the nominator we have the average. So average return on Microsoft minus average return on risk-free is the same. And this, if you are familiar with the original Sharpe ratio, the ex ante Sharpe ratio, corresponds to, in the expected world, the expected return on the risky asset minus the known and risk-free return. But let's go back to the Sharpe ratio. It's 0.10. So this says that the Microsoft stock has delivered a risk-adjusted return of 0.10. And then you can argue, but that's very good. Let's just buy Microsoft. It delivers a 0.10 performance versus investing in the risk-free asset. The problem is that if this statistics should govern some of your forward-looking decisions on what to do, you need to take into account that this is just a sample. It might as well have been completely different. And perhaps it makes more sense if we consider it from the point of view of mutual funds. Say a high-profile Barclays fund in US equities. They deliver this result and they get this Sharpe ratio and they communicate to clients and potential clients, so look, we have outperformed on a risk-adjusted basis. Please invest more in our funds. But then, of course, someone would say, but the history is no guarantee for future success. No, and that's exactly because that history is just a sample from a true population. So what we do normally is to test whether the result is statistically significant, so that we can reject a nil hypothesis of no excess risk-adjusted return. So this is one way of applying the Sharpe ratio in a statistical context, by assuming that the differential returns, they are normally distributed, or if they are not normally distributed, if we don't like that assumption, then we need a large sample size, so that we can apply the central limit theorem that states that with a very, very large sample size we can assume the normal distribution. Here we have 25 observations, so we cannot use the CLT, the central limit theorem, that states that we have to get more than 30 observations in order to apply the normality assumption. So we use the t-statistics instead, which is slightly biased to take into account this little feature. And I have it down here. We have the t statistic here, the t distribution. It looks very normal, and indeed it looks very normal. but if we put on a normal distribution, you would see that it has fatter tails out here. So in this case, we have a Microsoft stock that have delivered a Sharpe ratio of 0.10. It's here. But the critical level that we assume in this case, where I have taken a 95% one-side test, is here 1.771. So we cannot reject the null hypothesis of no excess risk-adjusted return. And it sounds very, very confusing, perhaps complicated, but it's really not. It's basic statistics, just with a set ratio or a set test or a t-test being the Sharpe ratio. It's exactly the same. So we test the result from the sample by putting it into the true population distribution, in this case the t, and we test it, and we can see, yes, you have delivered positive average return 0.85, you have delivered a positive Sharpe ratio, but we cannot exclude that this could be due to pure chance. You have not shown, or the Microsoft stock has not shown any particular skill that we can say, so that we can say that we can exclude the null hypothesis or reject the hypothesis of zero excess risk adjusted return. Very, very complicated long sentence. So again, this is often used in performance measurement of mutual funds because it's so critical for them in comparing with each other. And yes, that's really the ex-post Sharpe ratio. So really, really simple to calculate, and also relatively simple to apply into a statistical framework. Just one last thing that I didn't comment on was if you have a time series of monthly or quarterly or otherwise periods different from one, you need to adjust over here the Sharpe ratio both in the nominator and in the denominator. And in the nominator you adjust by a linear factor times 12, for instance, if it's monthly returns. Down here you have to scale with the square root of the numbers of periods in a year, so 12, square root of 12, for instance. That will leave you with the annualized return, Sharpe ratio, sorry. Alright, that should be it.